Welcome back to another weekly market and financial update. Wow, it is a scorching hot week, and of course, we have some scorching hot news. I know, dad jokes in honor of Father's Day, but it's true. The Fed meeting just finished up over the last few days, and they released a report with their forecast for the rest of this year. And for those of us that have been watching the dot plot, which is their estimated chart of inflation and where they want to keep rates at over the course of the year, last year it sort of started out about 4 dots or 4 rate cuts throughout the year. We know that that has since transitioned from 3 to 2, and now just 1 rate cut for the rest of the year. We talked a few weeks ago about how many rate cuts are likely this year. Again, I was sort of in the middle 50-50 between about 2 to 1, and now the Fed is in fact saying that they have 1 rate cut. They know that inflation is starting to cool off. The CPI numbers that came out last week were better than analyst estimates, and we saw the market, really skyrocket. The markets have been at all-time record highs since those data points have come out, which is really tremendous to see in light of what's going on in the rest of the world and really the uncertainty around the economy, right? But great news, again, the Fed is still predicting 1 rate cut by the end of this year. Now, in terms of portfolios and how that will affect each and every one of us directly, I think this is really going to come down to bond investors specifically. So anyone that has bonds in their portfolio, we know, right? Any bonds over the last few years have really just gotten punished. As rates have gone up higher and higher, bond values have dropped more and more. So the good news around this is now that we know that rates will be pretty consistent, really only with the 1 rate cut this year, is that yields on bonds are going to stay higher for longer. So investors won't have to chase after looking for high income in their portfolios. They won't have to take on extra risk unnecessarily to get those yields because bonds right now are yielding very, very nicely, right? And for those of us that have bonds in our portfolio and are still saying, well, my bond portfolio is still down, bonds have a nice feature that you can hold them to maturity, right? So what that means is that if you own a 5-year bond, and I bought it in 2020, in 2025, when it reaches maturity next year, my full investment in my principal will be returned to me. So if I put $1,000 into a bond, even though it might only be worth $700 today as rates have gone up, I'll still receive that $1,000 back next year at pretty much no risk to me, right? As long as that company issuing the bond doesn't go under or experience any solvency issues, I can basically guarantee that that $1,000 will be returned back into my portfolio. And I've been able to enjoy higher yields along the way, right? I might have been able to lock in a bond at 5 or 6%. Some bonds you might be able to find even higher than that in the marketplace. So again, for those of us that are looking to add some additional yields into portfolios, bonds can be a great way to do that, especially with how consistent rates are and knowing that the Fed now understands that doing too many rate cuts too quickly really isn't a benefit to them. They have acknowledged that CPI is coming down, but it's been pretty slow to come down compared to what they were really hoping for. So knowing that rates will stay relatively consistent, they're keeping their Fed funds rate between 5 and 5.5% right now as a target, and they're not really predicting CPI to come down to about 2%. That's their ideal target. Really not until 2026. So, we have about a year and a half worth of time in front of us to explore how to generate additional yield into our portfolios. And as we're talking about this a lot more, we're actually going to be hosting at Vision Retirement our Q2 market and financial update. I know I do these on a weekly basis, and they're meant to just be a quick recap of what's happened in the last week or what's maybe coming up in the very near future, 1 or 2 weeks out. But we'll do a recap of the full quarter, and then we'll also give our outlook over the next 3, 6, 9 months or so. So it'll be nice to actually see, I'm talking a lot about the numbers behind bonds. We'll look at the historicals of bonds and where they're at, where they're likely to go throughout the rest of the year. So if this is something you're interested in, it's a free webinar. Anyone is welcome to attend. We'll be pushing out the invitations later this week, or you can go onto our website, visionretirement.com, and under our events page, you're welcome to sign up there. That way you have access to the Zoom link. And again, we're encouraging everyone who wants to attend to hop on with us and hear our perspective on the markets and where we'll be now that the second quarter has pretty much come to a close. So thank you so much for tuning in. It's a super hot week, high 90s all week. So stay cool, stay hydrated, and I'm looking forward to talking to everyone next week, and hopefully it'll be a little bit cooler by then. Talk to you soon.